derivatives, options, trading strategies and put-call parity. Friends, let me introduce you to the topic. An option contract is a contract which is actively traded on an exchange and derives its value from an underlying asset like stock and stock indices. There are two parties in an option contract, the option seller, also as the writer of the contract, and option buyer. The option buyer has the right but no obligation to buy or sell an asset at the exercise price from or to the option seller or buyer within a specified time period. Now friends, let us have a look at options. First we will see its meaning. An option contract is a contract that, in exchange for the option price, gives the option buyer the right but no obligation to buy or sell an asset at the exercise price from or to the option seller or buyer within a specified time period, or depending on the type of option, a precise date, that is, expiration date. A call option gives the option holder the right to purchase the underlying asset by a certain specified date for a specified price in advance. A put option gives the option holder the right to sell the underlying asset on a selected date for a pre-selected price. The price in the contract is known as the exercise price or strike price, denoted as K. The date in the contract is known as the expiration date or maturity, denoted as T. And the current price of the underlying asset is the spot price, denoted as S. American options can be exercised at any time up to the expiration date. European options can be exercised only on the expiration date itself. Most of the options that are traded on exchanges are American. In the exchange-traded equity option market, one contract is usually an agreement to buy or sell 100 shares. European options are generally easier to analyze than American options, and some of the properties of an American option are frequently deduced from those of its European counterparts. Now friends, let us have a look at option position. There are two sides to every option contract. On one side is the investor who has taken the long position, that is, has bought the option. On the other side is the investor who has taken a short position, that is, has sold or written the option. The writer of an option receives cash upfront but has potential liabilities later. The writer's profit or loss is the reverse of that for the purchaser of the option. There are four types of option positions. Number 1, a long position in a call option. Number 2, a long position in a put option. Number 3, a short position in a call option. Number 4, a short position in a put option. Options are referred to as in the money, at the money, or out of the money. Now friends, let us understand what is in the money, at the money and out of money options. Call option, if say S is the stock price and K is the strike price, a call option is in the money when S is greater than K, at the money when S is equal to K, and out of the money when S is less than K. Put option. A put option is in the money when S is less than K, at the money when S is equal to K, and out of the money when S is greater than K. Clearly, an option will be exercised only when it is in the money. In the absence of transactions costs, an in the money option will always be exercised on the expiration date if it has not been exercised previously. Now friends, let us have a look at this illustration where first we show in the money option where under call option we have if k is equal to 100 and s is equal to 110, that is s is greater than k. Looking at the put option, here if k is equal to 100 and s is equal to 90, that is s is less than k. Now let us look at the second option, which is at the money option. If k is equal to 100 and s is equal to 100, that is s is equal to k. Under put option we have if k is equal to 100 and s is equal to 100, that is s is equal to k. Now let us look at the third option, which is out of the money. Here under call option we have if k is equal to 100 and s is equal to 90, that is s is less than k. Secondly, looking at put option, if k is equal to 100 and s is equal to 110, that is s is greater than k. Now friends, let us have a look at call option payoff. The payoff on a call option to the option buyer is calculated like this. Ct is equal to max bracket O, comma st minus x bracket closed, where Ct represents payoff on call option, St represents stock price at maturity and x as strike price of option. The payoff to the option seller is minus Ct bracket, that is minus max bracket 0 comma st minus x bracket closed. We should note that max bracket 0 comma st minus x bracket closed, where time t is between 0 and t, is also the payoff if the owner decides to exercise the call option early. The price paid for the call option, that is C0, is referred to as the call premium. Thus, the profit to the option buyer is calculated as profit is equal to Ct minus C0, where we see that Ct is equal to payoff on call option, C0 is equal to call premium. Conversely, the profit to the option seller is profit, which is equal to C0 minus Ct. Now friends, let us have a look at the put option payoff. The payoff on a put option is calculated as Pt is equal to max bracket 0 comma x minus st bracket closed, where Pt is equal to payoff on put option, St is equal to stock price at maturity, x is equal to strike price of option. The payoff to the option seller is minus Pt bracket, that is max bracket 0 comma x minus st bracket closed. We should note that max bracket 0 comma x minus st, where t is greater than 0 but less than capital T, is also the payoff if the owner decides to exercise the put option early. The price paid for the put option is P0, referred to as the put premium. Thus, the profit to the option buyer is calculated as profit equal to Pt minus P0, where Pt is equal to payoff on put option, P0 is equal to put premium. The profit to the option seller is profit is equal to P0 minus Pt. Now friends, we will look at some trading strategies involving options. Traders and investors use option-based trading strategies to create an extraordinary spectrum of payoff profiles. This enables investors to take positions based on almost any possible expectation of the underlying stock over the life of the options. Now we will look at options trading strategies. Firstly, we will look at covered call. When a long position on the underlying stock is combined with a short position on an out-of-the-money call option, a covered call strategy can be constructed. By writing an out-of-the-money call option, the combined position caps the upside potential at the strike price. In return for giving up any potential gain beyond the strike price, the writer receives the option premium. This strategy is used to generate cash on a stock that is not expected to increase above its exercise price over the life of the option. Now we look at point number 2, which is protective put. When at the money put long position is combined with the underlying stock, we have created a protective put strategy. A protective put is constructed by holding a long position in the underlying security and buying a protective put option. This is used to limit the downside risk at the cost of the put option premium, that is P0. Now let us look at point number 3, spread strategies. These strategies combine option positions to create a desired payoff profile. The differences between these options are either strike price and or time to expiration. They are as bull and bear spreads. In a bull call spread, the buyer of the spread purchases a call option with a low exercise price XL and subsidizes the purchase price of the call by selling a call with a higher exercise price XH. The buyer of the call spread expects the stock price to rise and the purchased call to finish in the money. However, the buyer does not believe that the price of the stock will rise above the exercise price for out-of-the-money written call. In a bear call spread is the sale of the bull spread. That is, the bear spread trader will purchase the call with the higher exercise price and sell the call with the lower exercise price. This strategy is designed to profit from falling stock prices. As stock prices fall, the investor keeps the premium from the written call net of the long call's cost. The purpose of the long call is to protect from sharp increase in the stock prices. Next point, butterfly spreads. A butterfly spread involves the purchase or sale of 3 different options. The investor buys one call with low exercise price, buys another call with a high exercise price and sells 2 calls with an exercise price in between. The buyer is essentially betting that the stock price will remain near the strike price of the written calls. However, the loss that the butterfly spread buyer sustains of the stock price strays from this level is limited. Next point, calendar spreads. A calendar spread is created by transacting in 2 options that have same strike price but different expirations. The investor profits only if the stock remains in a narrow range, but losses are limited. Diagonal spreads. A diagonal spread is similar to a calendar spread except that instead of using options with same strike price and different expiration, the options in diagonal spread can have different strike prices in addition to different expiration. Box spreads. A box spread is a combination of a bull call spread and a bear put spread on the same asset. The payoff to the box spread is always the same. So if the options are priced correctly, the payoff must be the risk-free rate. Next point, combination strategies. A combination is an option trading strategy that involves taking a position in both calls and puts on the same stock. Point number A, straddle. One popular combination is a straddle, which involves buying a European call and put, with the same strike price and expiration date. If the stock price is close to this strike price at expiration of the options, the straddle leads to a loss. However, if there is a sufficiently large move in either direction, a significant profit will result. A straddle is appropriate when an investor is expecting a large move in a stock price but does not know in which direction the move will be. Point number B. Stripes and straps. A stripe consists of a long position in one European call and two European puts with the same strike price and expiration date. A strap consists of a long position in two European calls and one European put with the same strike price and expiration date. In a strap, the investor is also betting that there will be a big stock price move. However, in this case, an increase in the stock price is considered to be more likely than a decrease. Point number C. Strangles. In a strangle, sometime called a bottom vertical combination, an investor buys a European put and a European call with the same expiration date and different strike. A strangle is a similar strategy to a straddle. The investor is betting that there will be a large price move, but is uncertain whether it will be an increase or a decrease. The profit pattern obtained with a strangle depends on how close together the strike prices are. The farther they are apart, the less the downside risk and the farther the stock price has to move for a profit to be realized. The sale of a strangle is sometimes referred to as a top vertical combination. It can be appropriate for an investor who feels that large stock price moves are unlikely. However, as with sale of a straddle, it is a risky strategy involving unlimited potential loss to the investor. Now friends, let us have a look at put-call parity. We will now derive an important relationship between the prices of European put and call options that have the same strike price and time to maturity. Consider the following two portfolios. Portfolio A, one European call option plus a zero coupon bond that provides a payoff of K at time T. This is equal to a covered call strategy. Portfolio C, one European put option plus one share of stock. This is equal to a protective put strategy. We assume that the stock pays no dividends. The call and put options have the same strike price K and the same time to maturity T. The zero coupon bond in portfolio A will be worth K at time T. If the stock price ST at time T proves to be above K, then the call option in portfolio A will be exercised. This means that portfolio A is worth bracket ST minus K bracket closed plus K is equal to ST at time T. If ST proves to be less than K, then the call option in portfolio A will expire worthless and the portfolio will be worth K at time T. In portfolio C, the share will be worth ST at time T. If ST proves to be below K, then the put option in portfolio C will be exercised. This means that portfolio C is worth bracket K minus ST bracket closed plus ST equal to K at time T. If ST proves to be greater than K, then the put option in portfolio C will expire worthless and the portfolio will be worth ST at time T. If ST is greater than K, both portfolios are worth ST at time T. If ST is less than K, both portfolios are worth K at time T. Because they are European, the options cannot be exercised prior to time T. Since the portfolios have identical values at time T, they must have identical values today. If this were not the case, an arbitrator could buy the less expensive portfolio and sell the more expensive one. Because the portfolios are guaranteed to cancel each other out at time t, this trading strategy would lock in an arbitrage profit equal to the difference in the values of the two portfolios. The components of portfolio A are worth C and K e raised to power minus RT today, and the components of portfolio C are worth P and S0 today. Hence, C plus K e raised to power minus RT is equal to P plus S0. This relationship is known as PutCall Parity. It shows that the value of a European call with a certain exercise price and exercise date can be deduced from the value of a European put with the same exercise price and exercise date and vice versa. Now friends, let us have a look at factors affecting option premium. 6 factors impact the value of an option. Number 1, S0, current stock price. Number 2, X, strike price of the option. Number 3, T, time to expiration of the option. Number 4, R, short-term risk-free interest rate over T. Number 5, D, present value of the dividend of the underlying stock. Number 6, sigma, expected volatility of stock prices over T. When evaluating a change in any one of the factors, hold the other factors constant. Current stock price. For call option, as S increases or decreases, the value of call increases or decreases. For put option, as S increases or decreases, the value of put decreases or increases. This simply means that as an option becomes closer to or more in the money, its value increases. Strike price of the option. For call option, as X increases or decreases, the value of the call decreases or increases. For put options, as X increases or decreases, value of the put increases or decreases. Thus, the option value will increase as it becomes closer to or more in the money. Time to expiration of the option. For American style options, increasing time to expiration will increase the option value. As with more time, the likelihood of being the money increases. Short-term risk-free rate over the life of the option. As the risk-free rate increases, the value of the call or put will increase or decrease. Dividends. The option owner does not have access to the cash flows of the underlying stock and the stock price decreases when a dividend is paid. Thus, as dividend increases, the value of the call or put will decrease or increase. Volatility of the stock price over the life of an option. Volatility is the friend of the option. As volatility increases, option value increases. This is due to the asymmetric payoff of the options, since long option positions have a maximum loss equal to the premium paid. Increased volatility only increases the chances that the option will expire in the money. Thus, it is considered to be the most important factor in option valuation. Now friends, let us have a look at option pricing model. A useful and very popular technique for pricing an option involves constructing a binomial tree. This is a diagram representing different possible paths that might be followed by the stock price over the life of an option. The underlying assumption is that the stock prices follows a random walk. In each time step, it has a certain probability of moving up by a certain percentage amount and a certain probability of moving down by a certain percentage amount. Option pricing using a binomial tree. The binomial model can be viewed as a discrete equivalent to the geometric Brownian motion. As before, we subdivided the horizontal t into n intervals. Delta t is equal to capital T divided by small n. At each node, the price is assumed to go either up with probability p or down with probability 1 minus p. One-step binomial model. The one-step binomial model is best described within a two-state world where the price of a stock will either go up once or down once, and the change will occur one step ahead at the end of the holding period. The replicating portfolio. The replicating portfolio is the key to understanding how to value options. In general, the replicating portfolio is a concept that holds that the outlay for a bankruptcy-free stock position should be the same as the outlay for a call position with the same payoff. To see how this works, let us define some terms. Term 1, P, which is equal to the stock's current price. Term 2, X, which is equal to the call option's exercise price. T equal to the time to option expiration. I equal to the risk-free interest rate. SU equal to the stock value in upstate. ST equal to the stock value in downstate. C equal to the value of the call option today. Now friends, let us understand all this with the help of an illustration. Let us calculate the value of the call option where P is equal to $100, X is equal to $125, time period T is equal to 1 year, interest rate I is equal to 8%, SU is equal to $200 and ST is equal to $50. Now friends, let us have a look at one period binomial tree. Here we can see that P is equal to $100, here SU is equal to $200 and ST is equal to $50. Here E is equal to CU equal to max bracket $0, comma $200 minus $125 bracket closed, which is equal to $75. CD is equal to max bracket $0, comma $50 minus $125 bracket closed equal to $0. The value of the option. Thus, the price of the option must be $75. Calculation of upward-downward movement. U is equal to size of the up move factor, that is e raised to power sigma square root t. D is equal to size of the down move factor, which is equal to e raised to power minus sigma square root t, which is equal to 1 upon e raised to power sigma square root t equal to 1 upon u, where sigma is equal to annual volatility of the underlying assets returns and t is equal to the length of the step in the binomial model. Calculation of the risk-neutral probability of upward or downward movements are then calculated as phi u is equal to probability of an up move, that is e raised to power RT minus d whole divided by u minus t. Phi d is equal to probability of a down move, which is equal to 1 minus phi u, where R is equal to continuously compounded annual risk-free rate. Two-step binomial model. In the two-period and multi-period models, the tree is expanded provided for a greater number of potential outcomes. The stock price tree for the two-period model is shown as, if it is S0, then in period 1 it would be SU and ST. Then in period T it would be SW, SUD or STU, which is further just SDT. Now friends, let us look at an illustration. Option valuation using a two-step binomial model where P is equal to $20, R is equal to 4%, U is equal to 1.15, D is equal to 0.87 and phi U is equal to 0.61, phi D is equal to 0.39 and annual standard deviation is 14%. Step 1. Calculation of up move and down move factors. U is equal to E raised to power 0.14 into square root of 1, which is equal to 1.15. D is equal to 1 divided by 1.15, which is equal to 0.87. Step 2. The risk neutral probability of an up move and down move, which is phi U is equal to E raised to power 0.04 into 1 minus D upon U minus T, which is equal to 1.0408 minus 0.87 whole divided by 1.15 minus 0.87, which is further equal to 0.61. Phi D is equal to 1 minus 0.61, which is equal to 0.39. The binomial tree for the stock is, if today S is equal to 20, then SU and SD in year 1 would be $23 and SD would be $17.40. SU is equal to $23, that is $20 into 1.15, and SD is equal to $17.40, that is $20 into 0.87. Further, in year 2, SUU will be $26.45, that is $23 into 1.15, and SUD would be $20, that is $23 into 0.87, or SDU would be $20, that is $17.40 into 1.15, and SDD would be $15.14, that is $17.40 into 0.87. From this, the values of call option in each of the possible outcomes can be determined. Notice that the only time that the option is in the money is when two upward price movements lead to an ending price of $26.45 and a call value of $6.45. The expected value of the option at the end of year 2 is the value of the option in each state multiplied by the probability of that state occurring. Expected call value in 2 years is equal to bracket 0.61 into 0.61 into $6.45 bracket closed plus bracket open 0.61 into 0.39 into $0 bracket closed plus bracket open 0.39 into 0.61 into $0 bracket closed plus bracket open 0.39 into 0.39 into $0 bracket closed, which is equal to 0.3721 into $6.45, which is further equal to $2.40. The value of the option today is the expected value in the 2 years discounted at the risk-free rate of 4%. Call option value here is equal to $2.40 whole divided by E raised to power 0.04 into 2, which is further equal to $2.21. Now friends, let us conclude today's session. The above can be summarized as options are mainly derivatives contracts in exchange for a price, and it derives its value from an underlying stock. There are two types of option, call option and put option, each having two positions, a long position and a short position. American options and European options are two main types of option. However, we commonly deal with European options. The premium of the option contracts is contingent upon whether the option is in the money, at the money, and out of the money. In order to hedge the risk, many traders, investors, and arbiters use various option trading strategies like protective put, covered call, spread, and combination strategies. Thank you, friends.